The purpose of this video is to discuss the accounting for dilutive securities, and more specifically, I'm going to discuss convertible bonds and convertible preferred stock. So the first thing is, let's start by defining or understanding what dilutive securities are. They're any type of security, any type of financial instrument that allows you to later convert to common stock. So initially, it's not common stock in form, whatever that financial instrument is. So initially, that bond or that preferred stock is not common stock, but then at a later date, it will enable the holder to obtain common stock, either through conversion or through the exercising of options or any other financial instrument. And we call it dilutive because the issuance of these certificates, the issuance of common stock, results in more common stockholder owning the company, right? So for the previous owners, it dilutes or it decreases their percentage ownership. So that's one reason why they're referred to as dilutive. The other reason is because, from our perspective in accounting, if there are more common shares outstanding, then it reduces earnings per share, right? Because the formula for earnings per share is the current earnings, net income with a few adjustments, divided by the number of shares outstanding. Well, if you have more shares that are issued in common stock, then the denominator is larger and hence earnings per share is lower. So make sure to, commonly we report basic earnings per share and diluted earnings per share. Make sure you watch the video on earnings per share so you can see the details on how that's done. All right, so why would a borrower, let's say it's a convertible bond, it's a company that wants to borrow money, why would a company issue such instrument? And a lot of times it has to do with the fact that it ends up costing the borrower less, right? You have lower cost of borrowing because you're adding that extra feature, that conversion option, that is a positive thing for an investor or a lender. And it helps out, and for the company that's issuing that convertible bond, let's say, it helps them have options in terms of how their capital structure is handled. From the investor's perspective, it's a positive thing too, because if you do believe that a company's prospects are good and that their price of their stock is going to go up in the future or something of that nature, then you would want to have that opportunity to convert to equity, right? To common stock. It allows you to perhaps benefit from future gains in that stock. And until then, before you convert, the other benefit for the investor is then you have a secured principal and interest for the most part, right? It's not guaranteed, but at least it's stated in a contract that you'll get a percentage of interest. All right, so just to be clear, the idea of a dilutive instrument or dilutive securities, any security, any type of financial instrument that it has the ability to be converted to common stock. Now, I'm going to give you examples of convertible bonds right here, and I'm also going to give you an example of a convertible preferred stock so you can see how that works. Okay? So let's look at the convertible bond first. Assume that you have a bond payable that's has a par value of $3,000 and was sold at a premium. And let's not worry about what the premium was. I understand that it was sold at a premium. Now that bond has a convertible feature which allows us to convert it to 100 shares of common stock for that company. And the shares have a par value of $10. Okay, so let's first think of when that bond was issued. Okay, this is the first thing. And I'm just going to say very easily, the accounting that you're going to do when the bond is issued is just the same as what you've learned in the past, right? If you want to refresh that, you can go to that video titled Long-Term Liabilities and see how that's done. But it's straightforward accounting. And it's, that accounting that you're doing based on this video here assumes that the feature is non-detachable, okay? That conversion feature. Let me write this here, non-detachable. In other words, the bond is either a bond at a particular time, or when you convert it, equity. So it's either debt or equity, but it can't be both. All right. So it's mutually exclusive. If you have that bond, then it's characterized as a debt for the company. But then when that bond is converted, then you no longer have debt in the books. Now it's equity, right? So that's why this accounting is very similar to what you've learned in the past. So here's just a quick little journal entry so you can see. If you issue that bond at a premium, you have a liability of $3,000, and then you have a premium. Whatever that premium may be, don't worry about it. It's P. So ultimately, the company, when they borrowed that money and when they issued that bond, they received $300 plus P. Over time, they will make payments of interest. And notice how I haven't given you any interest amounts, just to keep it simple. They'll amortize some of that premium over time. And that's what you will do, just like it's detailed in this video, okay? So very important for us to account for this bond in a similar way to long-term liabilities, like bonds payable. We assume that it's a non-detachable security, the conversion feature. I have a little note here. It says, if for some reason that feature is detachable, then you have to separate the valuation from the bond. Here, I'm including the conversion feature as part of the bond. I'm not trying to split up those values, notice. So this bond having a convertible feature is simply going to be valued at the 300 plus P. Now, if it did have a detachable warrant on it, then you would do the valuation separately. And at that point, notice how over here I said that the security is either a debt instrument or an equity instrument, but it can't be both at any point in time. If it's a detachable warrant, then technically you have two securities. You have a security that's a debt instrument, and you have the warrant that is an equity instrument, right? And that's why you have to separate the valuation. So to see how to account for that, see the video on stock warrants and options, okay? But here we're going to assume that this is the scenario where the conversion feature is attached, non-detachable part of the bond. All right, so this is nothing new. This is something you've learned in the past. Now here's what happens on the date of conversion. First of all, you'll use what we call the book value method. So there's going to be no gain or loss on the conversion. And here's additional information. The premium, the balance in the premium account is $200. Now remember, that premium started with an amount of P. You don't know what that is. But over time, you amortize it. Every time you make interest payments, etc., you amortize it. And it just happens to be on this date of conversion, whatever day that is, the balance in the premium account is $200. Additionally, on that same day that we're going to convert the bond to common stock, the stock is trading at $35 per share. This is the fair market value of that stock. So if we're using the book value method under this scenario, we will simply reverse out the bond payable that's here. We'll reverse out the premium. Remember, I told you it has a balance of $200. And then we will credit common stock for the par value for the number of shares that the contract stipulates. So if you recall, the bond says that these bonds can be converted to 120 shares. So we would go in here and multiply 120 shares times the par value, and that's where I'm getting this $1,200. And this is stipulated in the contract, right? So that's why we use the book value method. And then the remaining amount to make this entry work, which is $2,000, that goes into additional paid-in capital for the common stock. Now, got a couple little notes or extra things I want to mention here. The first one is, don't confuse this transaction with an extinguishment of debt. This is not an extinguishment of debt. If you go back to an earlier video where I discussed this, under an extinguishment of debt, this is when the company, okay, buys back that bond before it matures. And when I say the company, I mean the borrowing company. So the borrowing company wants to pay off that loan. In other words, buy that bond again. So they go out in the open market and they purchase or pay off the bond holders. And in those scenarios, you might have a gain or a loss, right? That's not what we're doing here, okay? Don't confuse those. This is a conversion, whereas what I just described right now is an extinguishment of debt. Those are two separate things. Now, under the extinguishment of debt, just to kind of refresh your memory, you would have the same thing that occurs here of reducing the bonds payable and the premium, but I would have a credit to cash, right? I would be crediting cash, and based on the differences, I might have a gain or a loss. But please don't mix these up. That's an extinguishment of debt. This is a conversion of debt to common stock. And notice how here we have no gain or loss, where under an extinguishment of debt, you may have a gain or loss. And the reason we have no gain or loss is because we're using the book value method. All right, we're valuing this transaction at the book value of the bond. Whatever the book value of the bond, that's what we're going to value the common stock portion or the equity portion at. All right, I have a little side note here that says, if an incentive, sometimes referred to as a sweetener, is given by the issuer of the bond, right, to induce conversion, then just add it as an expense. So, in other words, sometimes the issuer, in other words, the borrower, the person, the company that borrowed the money and issued the bond, sometimes they are interested in having bondholders convert those bonds into equity. Okay, and there might be reasons why they want to do that. It could be that their debt levels are very high, so when you do your ratios, debt is a high percentage of the company's assets or equity, whatever metric you're using. So sometimes they are interested in getting those bonds converted to equity so that they can reduce the liabilities. So when they offer that kind of stuff, it's a little incentive. Everything is the same, just like in the other journal entry, except you add that extra expense in there. Okay, so I'm assuming it's like $50. I'm making this up, obviously, but this is, just assume it's $50. So you have an additional $50 that the company says, all right, if you convert your bonds to common stock, then we will include an additional $50. It could be paid in cash, or it could be given in additional common stock, right? So I put it here as cash, but sometimes it could just be given in additional equity. So you would just include it as part of the additional paid in capital here. Okay, so that's the example on the bond being converted. Let me also discuss the example with convertible preferred stock. So we'll do this one here in light green. On the date of issuance of preferred stock, this is the same accounting as you've done in the past. So if you want to look at the stockholders equity video, you can refresh your memory on that. But when you issue preferred stock, you credit the preferred stock par value, and then any additional amounts go to additional paid in capital. So you're receiving cash X plus Y. So that in itself is like that. And again, notice how I am not valuing the amount for the conversion feature separately. This is all just one transaction. So this is a preferred stock that has a convertible option in it. What happens on the date of conversion? Same thing, book value method. Same thing as what we did here with the convertible bonds. I'm going to value the transaction at the book value of the preferred stock. So the book value would be the whatever is in preferred stock plus the additional paid in capital. So at that point, I convert it, so I reduce that preferred stock and I issue common stock at par. And then any additional amounts, I put in additional paid in capital, just like we did over here with the bond conversion. All right. Again, I want to make it clear that the contract stipulates the number of shares that are going to be issued, right? So in this case, whatever, in the bond example, I said convertible to 120 shares, right? In the preferred stock, since we're not putting in numbers, you would have the same thing. It would tell you how many shares are going to be issued. So you would put the par amount here and then any additional amounts into a pick. Now, here's a little side note here, just to be careful. This here assumes, let me move this out of the way here. This here assumes that the par value of the common stock is less than the book value of the preferred stock. So in other words, this amount right here is less than the combination of these two. It assumes that, and that's why I have an extra amount here. But if the opposite is true, if the par value of the common stock, if this amount right here, the par value times the number of shares you're given, if this amount right here is greater than the summation of X and Y, the book value of preferred stock, then technically you're not going to have extra for a credit. You would have to make up a debit here. So if that's the case, this is what this says. If par value of the common stock is greater than the book value of preferred stock, then you debit the retained earnings. So I'm just showing you right here what it would look like. If, I wrote short. I mean, this is not the technical way of thinking about it, but just so that you can remember, if you do this calculation and the summation of this is smaller than this, then you need a debit to retain earnings. You don't have additional paid in capital. Okay? All right, so real quick, let me recap what we've done here. There are certain financial instruments out there. In this case, I give you an example of convertible bonds and convertible preferred stock. So there are instruments out there that initially are not common stock in form, but if they are converted, like these two right here, then they become common stock. And when they become common stock, they dilute the ownership of other owners, right? So it's dilutive securities. And they also dilute earnings per share. Okay, in a future video, make sure you understand the accounting for other dilutive instruments like warrants and options. We'll go into detail with that. But this is the video on convertible bonds and convertible preferred stock.